Just give me 1 second, okay? I'll be there. Just give me 1 second.
Hi everyone. Good evening. We are just waiting for everyone else to join, and then we will start the webinar. Let's just wait for 5 more minutes. So I think in the interest of time, maybe we can start, Ishima, if you're fine with that. And participants will keep joining.
Yeah, sure. We can start.
All right. So welcome everyone. Welcome to this webinar about the right pitch deck and about understanding the term sheets. I want to thank Ishima, who is here with us today. Ishima has a long stint with ENY before she has joined and started Planify. He is currently the CIO at Planify India, and I think she will be able to help you with your questions regarding investments, how to raise funds, what kind of funding you should raise at what point of time, what kind of strategic investors you should onboard on your cap table. Also, I'll give a brief about Planify. Planify enables hassle-free equity fundraising. It is a platform which has raised over 100 crores worth of funds for upcoming startups. Planify has backed up startups with a valuation of 1,600 CR. Employees who are working in startups and who have availed ESOPs, they have helped those employees liquidate those ESOPs worth of 67 CR. So it is one of the biggest platform that connects angel investors to upcoming startups. And currently they are looking to work with SIIC for our incubated startups. So I'm happy to have Ishima today with us. So without taking much of your time, Ishima, over to you. And once again, thank you so much for taking out time for this webinar.
So firstly, thank you, Ankit, for having me here. and thank you everyone for joining the session. So just to give a brief intro about me, I have spent close to 12 years in the corporate world, almost 11 years with Ernst& Young. I was working with their valuations and business modeling team so far and looking out few of the Germany accounts. Last year itself, I have joined Planify as a CIO, where I look for the hidden gems where we can invest and ask our investors to invest into and earn good returns and can help those founders and those companies to reach to the new levels. This today we are here. I am here to actually discuss about the brief outline of the pitch deck and the hidden clauses in the term sheets where the founders needs to pay more attention. Which clauses is beneficial for the founder, which clauses are beneficial for the investors. So just to give you a brief idea about all these terms. So let's start with the webinar. Let me quickly share with you a presentation. Yes. So today we are going to deep dive into how to create the pitch deck for the investors. I have planned to divide the whole section to two different parts. The first would be we are going to discuss the basic outline or the structure about how to create the pitch deck. And second would be discussing about what all needs to be covered, that is do's, and more specifically what need not to be covered. While discussing about the basic outline of the pitch deck, I'll try to share some key insights about each slide. For instance, such as market slide, where we find the multiple founders struggling how to compute the TAM, the one of the most used jargons by the investor base, which is nothing just the total addressable market of your product or your service. So why today? Let's deep dive more. So every single day we receive not less than 20 pitch decks from startups. And if I'll tell you that on an average in 2023, the VCs and the private equity funds have not spent more than 2 minutes and 44 seconds to evaluate a pitch deck. So that is actually the time that VCs and angel net platforms has given to check the pitch decks. So we believe that the founders live with their business day in and day out, and they wanted to present everything because for them, that's actually their baby. But the investors don't really have the time to go through those 15, 20 slides. So we are going to discuss about how to gain the attention of the investors and to create a deck which is investment ready. Let's start with the pitch deck structure. You've seen multiple people posting on the YouTubes, on LinkedIn, blogs and articles about like more or less the same thing, the same content, the same 10 to 12 slides, which needs to be there in your pitch deck. Always and always remember that your pitch deck is actually like a cover letter of your business. This is actually more like a first impression, which might get investors' interest, and it needs to look stellar. I generally see the first 4 slides where the founders present their case, the problem statement, the solutions they're offering, and this is a very, very critical part of your pitch deck because there is a high probability that you will lose the investors' interest or could be possible that you might actually win their attention for the rest of the presentation. So the cover slide. So 2 very plain simple words for this slide is simple but elegant. It should have a good background with the company's logo and name of the company. So if you'll see at my screen, we were creating a pitch deck for a toy manufacturing company. So we just had the logo, we just had the name of the company, and that's it, nothing else. And then problem slide. So this is basically presents a status quo. Just explain the current problem in the plain 3 sentences. I prefer 3 or 4 sentences, not more than that. And the problem statement should be like a reality check for your investors. It should be without any complicated jargons, 100% straightforward, verifiable statements, and simple to understand. Never and ever make any questionable statement. And this is one of a very important investment thesis that we follow in Planify too also. We're always looking for the companies who are actually solving the real life problems and then creating a solution instead of first creating a solution and then looking for a problem. It should not be that way. At this point of time, you need to make the investors relatable with the problem and then take advantage of it. Then we come to the solution slide. This slide basically presents about the solution that your company, your product, your service is offering. 3 problem statements that you have mentioned in the previous slide. Now 3 solutions that you're going to provide. One do about this slide is don't mention the features of your product. Always mention the benefit of your solutions. Let's understand this with an help of an example. So hypothetically, you're into the EV vehicle manufacturing company. So instead of saying that we have 1,000 megawatt watts battery or something, to simply say that we provide a battery life of 8 hours at one go. Or for another example, so our toys are made of this is raw materials. Just simply say that it is plastic free toy, which is not bad for your kid, which is non-toxic. So something which actually adds to the curiosity of the investors, something with which your investors can relate to, and which actually like build up that kind of curiosity that investors wants to go to the next slide. So then after the problem and the solution, we come to the product portfolio slide. There are a lot of do's and don'ts about this slide. So if you're going for a one-on-one meeting, it's always better to go with a recorded version instead of presenting the demo, because you're always at a risk of demo crashing. And if you're sharing the pitch deck over an email, it's always a good idea to attach a video deck too, because it's a rare chance that the investor will go to your website, will create a login, and then will watch the video. Always remember, whatever you present, whatever way you present, the investor should have a feeling of wow at the end of your product portfolio, at the end of your problems and solutions. So the first section that we have talked about so far, it should not be more than 1 or 1.5 minutes. Once you have got all the attention, now it's actually to prove that how you're going to make them rich. Always remember, everyone love numbers, everyone love returns. So, ugly truth, investors don't love you. They don't love your product. They don't love your service. They actually love the idea of getting rich. They actually love the idea of how your product, your service, under your vision can grasp this market opportunity and create a sizable company, and most importantly, give them good returns. So the market size that you'll see here, there are multiple ways to present your market size. In this slide, we wanted to present that how big is the opportunity, that in India, there are only very few big players who are actually manufacturing the toys. And there's a lot of space for the domestic players, because all these companies are like the international players. They have actually created the subsidiaries in India, and how the recent private equity funds are actually investing in this particular sector. And recently, Azim Premji office has actually also invested in one of the toy manufacturing companies. So we wanted to brought up that kind of curiosity. In this particular slide, how do you calculate your market size? So this is one of the slides where we have seen a lot of founders struggling in between. So wanted to spend a couple of minutes here. So there are generally two ways how to compute a market size: is top-down approach or bottom-down approach. The top-down analysis basically involves determining the total addressable market and then identifying your share of market. So what is TAM, or total addressable market? It is nothing, just the total market demand of a product or a service. And then you must have heard about the serviceable addressable market, which is nothing but just the segment or geography or the customer that your product is actually catering of. And then the bottom up analysis is actually estimating the potential sales of your company to determine a total sales figure. The major goof up that any pitch deck we have seen so far is, you must have very oftenly heard this line that, do you know the total addressable market is $100 billion, and even if I get 1% of it, our company will be $1 billion. This is the top-down approach, which is quite unrealistic, to be honest, because either this is the size of the whole market, or if this is the size of your competitors' market, but this is not yours, because you have not even come into existence, or you are very new to this market, you're very like a small part of this market. So let me explain you with an example. We have worked with various health tech companies, and in the market slide, they've all been mentioned the statements like, if you look at the size of this particular disease in India, it is like a 5,000 crore market. And even I'm getting get 1% of it, I'll get like 50 crore market bare minimum per year. But this is not your market size. This is actually the market of the whole disease. So this is another example could be like Maruti manufacturing maybe 10 crore automobiles. So this is Maruti's automobile production. This is not yours. So these are all the reasons why the top-down approach does not work. Hence, it is always advisable to do the bottom-up analysis and document your assumptions and show how you have calculated your own TAM. The basic formula to compute the TAM by using the bottom-down analysis is the customers that you're going to cater off, like the number of customers, into the price. So, however, for the early stage companies, it is always difficult to get the price because you have not tested the waters, you have not entered into the market. So let me take you through an example to make you understand how you can compute the price of your product. So for example, few days back, we were working with one of the SaaS-based company. And when we sat down with the founders to understand their market size calculation, as per them, so their market size is $1,000 billion or $100 billion, because that is actually the SaaS market in India. So we have started asking them the questions that what exactly are you catering of? Are you catering of the whole SaaS market? And so your solution applies to all the industries. So then they said, no, we just only providing solutions to financial institutions. Then again, the same loop. All the financial institutions, NBFC, small finance bank, large giant banks, maybe Morgan Stanley, JP Morgan. Then they said, no, we just provide the solutions which does not have a proper technical team, does not have a CTO. So then by digging down, going on, then they realize that their solution is actually catering to the small size, like a mid-size banks, which is actually their sweet spot. And then when we come to the price, so they told us that we'll keep the price as like 1 lakh rupees. Then we asked them, okay, 1 lakh per branch, per month, yearly, annually. So it is very important to define the unit. Secondly, we've asked them, okay, how you have reached to this 1 lakh rupees? They said that our competitors are actually charging this much amount of money. So it's like, okay, so your competitors are charging 1 lakh rupees. So they said, no, our competitors are charging like 1/10 of like 10x of this. But then your product could be better in design, better in quality, better interface, better features, more efficiency. So if we take into consideration, the cost of production itself is 1 lakh rupees. So even if you charge like 1 lakh rupees, you'll anyways reach to a break-even level. You'll never become profitable organization. So even then they understood, okay, we have to keep some margin because our product is much better than the competitors. So while doing this analysis, we realized that they have come to like $100 billion number. And after doing all this kind of analysis, they have come down to a very lower number, which is actually a more accurate number. And this is like the first reality check to the founders that why they're not getting any reward from the investor base. So this is about the market size. And then it's about the business life. So it can make or break your chance. Make it as simple as possible for the investors. For instance, if you're into transaction-based business, such as Paytm, then simply Airbnb, just simply see that your cut, like 1.5% commission on every transaction. As simple as that. Like whatever transaction happens via my platform, I charge 1.5% of that. It should be that simple. Or either discuss about the unit of economics, which actually got very popular after the Shark Tank, that how margins are distributed. So in this slide, I've presented that, okay, if my transaction size is 200, my gross profit would be this, my EBIT would be this, and at the end, out of this 200, I'm taking 30 rupees back to my pocket. And then how are you going to earn this 200 rupees revenue? You're going to book this 200 rupees. So these are the different channels from where I'll get all my revenue. Then one of the other most example slide is the competition slide. So there are many different ways to discuss about who is a competitor, how they're performing. So this is one of the way where you can compare your financials with your competitors' financials and to tell them that how you are better off with them. But this could be possible for those companies who actually have some revenue or they've actually got some kind of traction. But in case if you do not, you are a very early stage company. So this grid approach to comparing your company via competitors is actually got very famous by after the Steve Jobs when he compared the iPhone with other phones in the market. If your product stands out far ahead than your competitor, using this representation is actually a very good choice. In this representation, you need to identify those factors which makes your product look very outstanding. Maybe like affordable, expensive, automation, manual. So these could be your 4-grid approach. In this slide, the biggest don't is never and ever say that you don't have any competition. For instance, like even if you are into the EV vehicle market and you say that, I do not have any kind of competitors, but you're forgetting one point is that the existing automobile, maybe like the transport, the public transport is actually your competitor. You are actually going to take away their market. So don't say that you don't have any kind of competitor. There's always one or the other competitor you have in the market itself. Then the next slide is the underlying magic or the competitive advantage. Just give me 1 second. Yes. This slide is where you elaborate all your advantages that you have on your competitors. such as in the form of technology, patent, any government scheme, any distribution channel that you were able to crack, but your competitors were not able to crack and they're still struggling. Anything that actually makes your product or service very unique. This is the point to actually showcase your moat that you have over your competitors. Then the go-to-market strategy. So it should state about your plans to acquire mass audience, to make people know about you, how to earn the revenue you have projected so far. So the one don't about this slide is don't discuss about like offline. So I'll earn my revenue from offline or online. So these are not actually your go-to-market strategy. These are actually the way of your sales, like the channel of your sales. These are not your go-to-market strategy. So now the reality is no one knows about whether the plan will work, but it is always advisable to pitch your investors with a plan instead of going without it. You need to try them at first place to know whether they work, or you must likely to update on the regular basis. So trial and error is actually one of the key important elements here. And always pitch with 100% confidence that your plan will definitely work out. The key point is to know that what you are doing and how you are doing it. That is actually the most important thing. And you have figured out to get what you have proposed to your investors. Mostly the ideas do not fail because the idea is not good. Actually, the idea got failed because execution, consistency, the efforts lack. So you need to convince that you have both the idea and the execution skills to achieve the same. Then the team slide. You must have heard that from like very common line from the VCs and from the angel investors that we don't bet on the product, we bet on the founders. And that's where this slide is actually to prove that. So the investors just want to know that, do you have the enough experience? Why are you the right people to grow this company? Why should we invest in you and why not to some other investor, some other founder? Sorry. Always remember the 3H here: hustler, hacker, hipster trio. The hustler, the CEO, the executor, and make everyone interested about the company. Hacker, definitely the CTO. And finally, the hipster, CMO, Aman Gupta, of course, they're responsible for creating brand equity and the brand value of the company. In fact, if I'll tell you that Aman Gupta is actually in one of the interviews said that after got so much publicity from the Shark Tank, the board has not spent like even a single penny on the marketing because the kind of brand, the kind of marketing he has got from Shark Tank. So don't, for this slide, please do not talk about those persons who are not fully committed to the company, as it very actually build up a very negative notion to the investors that the founding team in itself is not confident enough about their product or about their service. Second, I'm a sole founder and I don't need a team. So there's nothing wrong with the sole founder, but a strong team is required. And someone who is not appreciating the presence of the good team is actually a kind of a red flag for us. Then it's all about the traction. The traction is actually one of the crucial part for your pitch. Everyone loves number. They're interested how you're going to make them wealthy. If you're earning good revenue and you're growing, then this slide should have only one chart talking about your growth. And if you're a pre-revenue company, then talk about the metrics which is important for you to evaluate your performance and set the stage. For example, hypothetically, you're going to start up an e-commerce company. You do not have any kind of traction so far to showcase. Then tell them that how you're going to achieve the users, or maybe the retention rate, the churn rate. And so these kind of matrices you need to publish, or maybe like the order book value that you already have, the kind of demo that you have run, the kind of feedback that you have got. So those kind of pointers can be come into your traction slide. Last is the funding information, the fundraising information, very plain and simple. What is your ask and how much you are and how you're going to actually spend it. Don't, for the whole pitch deck is, please don't create a FOMO here. For instance, we actually have a lot of interested investors and we're closing the group by next week or end of this month. Investors will be like, okay, good for you. So creating an urgency is like a kind of a turn off for the investors, because for them, fundraising is like a marriage. It is not like kind of a sprint, or it is not like a ring ceremony. So for them, it's like a marathon, not a sprint. So this is more or less about the pitch deck. The next topic would be the term sheet. The term sheet, this has actually like a intent to invest. This is a non-binding agreement that outlines the main terms and the conditions of the potential deal. It is actually a summarized version of the eventual SHA and SFPA definitive agreement that parties would sign. You must have heard about like term sheet is like engagement, while HSA is like a marriage between the startup and the investors in some sense. You always heard about like term sheet, SSA and SPA. So the one common difference among them, like one very prominent difference among these, that term sheet is a non-binding agreement. SSP and SHA, SSA, they are more like a binding agreements. As mentioned, term sheet summarizes various terms and the conditions regarding the investment, and one of them is the valuation. You must have heard about like pre-money valuation, the post-money valuation. Pre-money valuation is basically, in a very layman language, it speaks about the worth of your company. Pre-money valuation is basically the value of the company before funding, and post-money valuation is after the funding. So how do you calculate the post-money valuation? Is basically the pre-money valuation plus the investment amount. There are two scenarios that I wanted to highlight here, which actually can impact a lot of final valuation or dilution or the exit. Let's understand with one of the examples. So this is one of the scenario. So if I'll say that, okay, I'll fund your company at a valuation of 10 CR, hypothetically. Now here, just by saying that your valuation is 10 CR, it could be pre-money valuation, it could be post-money valuation. But not using this word like pre and post actually makes a lot of difference. So in this first example, I'm saying that the pre-money value, the valuation is 10 CR, and hypothetically I'll consider, okay, 10 CR is my pre-money valuation, and investor is ready to invest like maybe like 20 lakhs. So and then the total value would be 1.2 CR. But because of considering this amount as my pre-money valuation, the shareholding would be 83.3% for the founder and 16.7% for the investor. But if I just change the word from pre to post-money valuation, so I'm saying that, okay, the post-money, the valuation that I've quoted like 1 CR is actually the post-money valuation. So now the investor is investing 20 lakhs. So the founder's worth would be like the pre-money valuation would be like 8 CR. So see the difference between the cap table. So the word of pre-money and post-money actually makes a lot of difference to the shareholding pattern. So please pay attention to what actually investor is communicating, whether he's going to invest the money at a pre-money valuation or at a post-money valuation. The next part that I want to discuss here is after the clarity that we have assumed, okay, the 1 CR would be a pre-money valuation. The next question that we usually get from the founders, okay, am I going to issue the shares at a pre-money valuation or at a post-money valuation? So I've actually shared this calculation, and if you want, I can share the Excel file also with you. Always those numbers, the new shares that we're going to issue is at the pre-money valuation, not the post-money valuation. So these are the two scenarios that please pay attention while calculating it or while creating a term sheet. First is to identify at what valuation he's speaking of, the investor, either it is a pre-money valuation, post-money valuation, and the number of the shares that you're going to issue, the additional shares that you're going to issue is always at the pre-money valuation. So there are a lot of terms and the conditions which mention in the term sheet. Few are very like friendly to the investors, few are very friendly to the founders. One of them is the liquidity preference. Liquidity preference could be beneficial to the founder, could be beneficial to the investors. But here, there is this liquidity preference actually makes a lot of difference at the time of the exit. This is more investment friendly. Liquidity preference speaks about at the time of the exit, at what multiple I'm getting my returns. I've actually tried to show you the calculation with the help of an example. Please let me know if everyone can see my Excel file here. If not, please let me know. Ankit, can you see the Excel file?
No, we cannot actually. We are just seeing your presentation only. Maybe you can unshare and share again.
Yeah, just give me 1 second. Let me know if you can see my screen now.
Yes,
The Excel file.
we can.
Right. Okay. So this is actually a small template that I've created to show you how liquidity preference can make a lot of difference in the cap table at the time of the exit. So this is like a very dummy numbers. So hypothetically, at the initial stages, whatever the liquidity preference that you have signed off, your cap tables looks like this, that the founder will get like 35% stake at the time of the exit. Series A investor would get 25% stake and Series B 40% stake. In this liquidity preference, I'll just change like one number and see the difference here. You're going to lose like 10% of your cap table, and the Series B will get like more, 10% more. So you have to be very cautious about what liquidity preference they're going to mention in the term sheet. So I'll just quickly take you through this example. Assume that at the time before the VC round, so just to set the stage, the VC, this company is going to raise 2 rounds, Series A and Series B. But before the VC round, he has 50 lakh shares. At the investment size in the Series A round is 50 lakh rupees. So the pre-money valuation is 1 CR. After the funding, as we've discussed, the post-money valuation is basically investment amount plus the pre-money valuation. So how much the Series A investor has got? Very simple. Your whatever the amount he's invested divided by the post-money valuation is the Series A investors post-money ownership. So how much the total number of shares would be? The initial number of shares divided by 1 minus the Series A investor stake. This will be your total shares here. Here, while signing the term sheet, Series A investors has told me that I'll have 1x of liquidity preference multiple. That what does it mean? That at the time of the liquidity event of a company, I'll get whatever I've invested multiplied with 1. That means whatever I've invested, I'll get the same amount of money. If I've put in 2x, that means I've invested 50 lakh rupees, but I'll get 1 CR. So that is a liquidity preference multiple here. After this round, so the now Series B is more like to expand himself. He has got more order book values. He wanted to expand his business, to open his offices in the other geographies. So he planned to raise another round. And in this round, the investment size would be this, 20 lakh rupees. And my pre-money valuation is 6 CR. 2 CR and, no, sorry, so 6 lakhs. And then the post-money valuation would be my 8 CR. So what would be the Series B investors post-money ownership would be 2 CR divided by the 8 CR, that is the 25% stake. And Series A investors, so obviously initially you, so here we're talking about the dilution. So initially you had like 100 shares were there, 50 shares were lying with with you, and 50 shares were lying with the Series A. So the stake would be 50-50%. But in the next round, I have got like the total number of shares is 120. So you have got another person also in your cap table. So what would be your stake would be now divided by this. So your stake will actually get diluted because more people is actually entered to get the share of that pie. So after the Series B round, Series A ownership, Series A investors ownerships actually get diluted from 33% to 25%. But the main difference here is in the Series B, the investor said, I'll not take 1x multiple, I'll take 2x liquidity preference multiple. That is, at the time of the exit, instead of having 2 CR back, I'll charge 4 CR. Very plain and simple. We agree to the liquidity preference multiple, whatever the investor gave it to us. Now, the exit event happened. And at the time of the exit, we have assumed that our valuation of the company is 10 CR. So I've just created a very small table here. Series A investors, INR amount, whatever the amount he has invested, it's 50 lakh. We have taken it from here. And then the Series B, how much is invested? 2 CR. What was the liquidity preference? 1x, which is 50 lakhs again. And what was the liquidity preference here for the Series B? 2x, which is 4 CR. The ownership at the time of the exit is Series A investors hold 25% stake. Series B investors hold 25% of the stake. Whatever remaining is with the common shareholders. Exit value if converted. So now the valuation of the company is 10 CR. I hold 25% of the stake. How much will I get at the time of the exit? 25% of the ownership into 10 CR, which means 2.5 CR. I've invested 50 lakhs, but at the time of the exit, I'll get 2.5 CR. Same for the Series B investors and for the founders. This is the conversion threshold. Conversion threshold is nothing. It just basically speaks about selling price at which the VC firm would be beneficial to convert into common stock rather than staying in the preferred stock. So basically, this is the minimum valuation that should be there, which will help them to get their principal amount that they have invested in your company. So this is the bare minimum valuation of the company should be there so that he can get back his money. So now let's compute the proceeds here. So 10 CR is my valuation. Series B investors proceed would be minimum of or either the liquidity preference 2x, or if I'll convert my preferred equity into common equity, so this will be my preferred. So whatever will the minimum of this will be my proceeds. So out of 4 CR and 2.5 CR, what is the whatever is like the maximum will be here. So he took like 4 CR. I'll take 4 CR liquidity preference. The left is 6 CR for the Series A investors. Either I can take 50 lakhs because I have chosen 1x multiple, or I would convert my rights and I'll take this value of converted 2.5 CR. So what is left here is whatever the left amount is there. This is founder or for other the shareholders, the stakeholders. So if you'll see here, the Series A investors received 2.5 CR, Series B investors took 4 CR, and founders took 3.5 CR. So this is actually the shareholding pattern. Hypothetically, if the valuation of the company is not 10 CR, it's only 3. So see the change. Everything goes back to Series B investors. Why? Because he has chosen 2x multiple. He has invested 2 CR. Bare minimum, he will take 4 CR from the proceeds at the time of the liquidity event. So, but your valuation of the company is only 3 CR. His liquidity preference was 4 CR. If he will convert his ownership rights, he will only get 75 lakhs. So whatever is the maximum, so either 4 CR or 75 lakhs, but you are getting only 3 CR. So everything will go back to Series B investors. You will get nothing. None of the stakeholders will get anything. So this exit multiple, this small multiple makes a lot of difference here. So at the time of 10 CR, you will get something. But at the time of less than that, you will get nothing. Even if we'll put it 5, even then, the Series B investors got the 4 CR and Series A investors got some of his funds, but you still didn't get anything. That is how these small things makes a lot of difference in your term sheets. Let me quickly get back to then the tag along. So after from the liquidity preference, there are tag along and drag along rights. Tag along rights are more investment friendly rights. Tag along rights actually give the minority shareholders the right to join the transaction and sell their minority stock in the company. So for instance, tag along rights can make the selling process more difficult in some of the instances. So for instance, like if one of the VC wants to buy the majority stake in the company and order like 2%, 5%, so they have the right, then they can tag along with the majority shareholders to sell off their stake and exit. So this is actually to safeguard the minority shareholders. In some of the instances, we have seen that tag along rights actually make the selling process more difficult. Why? Because it becomes harder to complete the sale when the potential buyer does not want to increase or change the terms of their offer in order to please the shareholders, to please the minority shareholders. On the opposite, the drag along is more founder friendly, because this provision actually prevents any future situation in which our minority shareholders may in any way able to undermine the sale of a company that was already approved by the majority shareholders or a collectively majority of the existing shareholders. So in the drag along rights, it actually gives the right of a founder or the shareholders to drag all the minority shareholders to join in the sale of the company. It also, and then after the drag rights, there are multiple multiple clauses which is mentioned in the term sheet. After from this, we have anti-dilution rights. This is basically to safeguard of the interest of the investors. You must have heard about this down round valuation, like the pharmacy and all these companies have actually buy juice. They have the down rounds. What is actually the down round is, hypothetically you have raised funds of at the valuation of 10 cr. The next round that you have raised the funds at the valuation of 2 cr. So basically this is a down round. You're raising the next round of funding at a lower valuation. So to safeguard your interest, because if the valuation gets down, your stake also gets down, the value of your stake gets down. So in that case, the company has to issue the new shares to investors to maintain their stake. This is actually for an investment friendly right. Right of first refusal, right of first offer, right of first refusal actually it provides, like the non-selling shareholders could be me, with the right to either accept or refusing an offer from the selling shareholders, that he first has to offer the stake to me instead of going it to the new investor to sell the shares. So for instance, if um, uh, I got an offer to sell my stake at rupees 90, but I have to first approach to the company that, see, I have got a third party to get my shares at rupees 90. Would you, I am bound to offer it to you first. So it depends upon me whether I wanted to buy at rupees 90, or I'll give you the authority that no, you can sell it to the third party. I do not want the shares. The right of first offer, it provides the non-selling shareholders with the right to make an offer. So in this case, right of first offer is basically, now the founder, the non-selling shareholders, I have the right to make an offer for the selling shareholders, that before the selling shareholders can solicit for the third party offers for its shares. It's actually, what is the benefit of the offer for the investors? This is actually one of the way to get to know what is the price of the shares in the market. Such a right, however, is actually a time bound. The offer right is actually very time bound, and therefore, after the expiry of the period, the seller is free to pursue the other buyers. So there are multiple clauses which is available in the term sheet. You must have heard about, like the board seat, the corporate governance, the exit options, cap table, and affirmative rights. But there are certain points that I wanted to highlight for a founder to seek into the term sheet, because these are more like a red flags in any of the term sheet. Um, Second, yes. So the certain red flags in a term sheet while signing up it, first could be the protective provisions. So you must have seen about like affirmative rights or these kind of rights, where an investor can stop you to maybe raise any kind of debt, to issue any kind of shares to raise more fundings, or to resign, anything. So these are kind of protective provisions. So please see to it what kind of provisions investors are putting in a term sheet, because it could seriously hamper the day-to-day operations. Cumulative and payment in kind dividends. Always make it sure whenever you're signing the term sheet, there is a word non-cumulative mentioned there in the term sheet, because this is the most founder friendly language to look for. Cumulative and payment in kinds could be like, cumulative dividends are basically that the dividends get accumulated against shares that founder is going to issue you, because this is not standard for an early stage seed. You must have seen like Britannia, or the different kind of companies which has actually reached to a growth stage companies, and they're releasing the dividends, because for them the growth in the share price will be difficult because they've reached to a maturity stage. But for an early stage company, they've actually started their operations, and there is a massive market is available to penetrate, to take care of. So for them, the growth in the share price is easy. For them to cater off the dividend demand is difficult. Hence, always look for the name of non-cumulative. Then again, the liquidity preference that we have talked of, that always make it sure anything above one liquidity preference could be harmful for you. If they mention that they'll get 2%, 2x or 3x or 5x, please hold back, sit back, compute it the way I've shown it to you, that how much it can impact your cap table, your exit opportunities, your shareholding pattern. So these are a few of the red flags to see in a kind of sheet. So that's all from my side. I open the forum for the questions. If anybody would have any questions for me.
Yeah, thank you so much, Ishima. I'll request our participants, attendees to kindly post in their questions. I think we have a question.
Okay.
Would you like to address it?
Yeah, please.
Difference between a pitch deck to incubators and to venture capital rounds.
Right. So that's a good question, actually. So pitch deck to incubators. So actually, you have an answer in your own question. Incubators, you are going to an incubator once your product is actually in an ideation stage, and you have to have like a prototype there in your pitch deck, that how you are going to have your product be ready, and like a map, like an outline, that this is how I'm going to present my demo, how I'm going to plan to introduce my product into the market. These are kind of market strategies that we would have. And to the venture capital rounds, it is very important to present the traction that you have achieved so far with your product. So that is one of the biggest difference between the pitch deck to the incubators and pitch deck to the venture capital rounds. Because if you're approaching to a venture capital, that means you already have a minimum viable product available with you. You have run the demos, you have won some kind of traction, you have won some kind of visitors on your website, you have some feedback, and what is going to be your plan to make it bigger. I hope I was able to answer your question.
Yeah. Any other questions we have from the participant? Yeah, there is one.
Yeah, sure.
Could you share the liquidation preference sheet template with us?
Happy to do that. I'll do that.
Yeah, we'll share that. We
Yeah,
have
I'll
the
share it with you,
registration.
Ankit, and you can share it to the participants.
Sure. Any other questions we have? Okay, so meanwhile we receive questions. I wanted to ask a question on behalf of the startups which are incubated with us.
Right.
So most of the funding requirements which we face from our startups, Ishima, is related to startups which have developed their prototype or MVP and are now looking to commercialize their product, their technology, and they need support for setting up the capex infrastructure which is required. So how do they arrive at the first number for fundraise, and how do they raise funds because they don't have any traction as such?
So very good question, actually, Ankit. So recently we are actually funded one of the company that is this company is into the specialty chemicals, and they yet not have achieved any kind of traction so far. In fact, this project is worth of 250 CR, and this person has yet not acquired any kind of land, to be honest, and still we have funded him with a check size of 25 CR. Why and what matrices actually helped us to evaluate this project was, first, we have a lot of sector specialists with us who help us to evaluate the companies. Second, we have so this person has actually got an approval from the bank about like for the loan. And third is the supply demand gap, like the product they're going to introduce into the market. We have analyzed the industry. We have analyzed that there is lot of supply demand gap in the market, and if this person would come into the market, he have enough opportunities to earn back his capex and to have more revenues and returns. So these kind of metrics is like supply demand gap, or the margins, the competition is actually help you to evaluate those kind of companies, because these factors back up those kind of capex intensive companies.
Okay. Thank you so much. We have three questions. I'll start with the first one.
Sure.
Could you please elaborate on the market size for health B2B startup at design stage seeking a pre-seed stage investment?
Right. So market size for health tech B2B startup. Right. So first of all, we need to understand that health tech company, this is catering to which particular sector, first, like for particular segment. Second, does your product applicable to all the hospitals, to all the healthcare users? So there are multiple healthcare users. I mean, you're a doctor, you must know it much better than me. So you need to dissect, you need to, out of like the healthcare industry involves a lot of different segments. First, you need to analyze which particular segment your product is going to be applicable. And then if your product is for the old age people, your product is for the adult people, your product is for the kids sector, so then you have to dissect it. And these are the different ways where you can dissect and can understand your market size.
We have another question. How quickly can we assess the terms and conditions? Generally, how much time do we get to decide about the same? And could you share some quick metrics to assess the term sheet?
Take as much time as you can. Please don't rush to it. And I always advise to consult a specialist, a lawyer, or any person who has been involved into the startup fundraising, because this is like a make or break. It could be possible that investors can take a significant control over your business. So please do. I have seen term sheets getting signed up within a day, within a week, and I have also seen the term sheets getting delayed for 6 months. So please take as much as time you want to do it. And could you share some quick matrices to assess the term sheet? I've already shared like the liquidity preference link, the anti-dilution rights. So it's all, I personally, what I do is I always sit back, I open my Excel file, I put down all the numbers and to see what would favor me and what would favor the other party. So for this, like, this is my personal thing. I always do it. I'm like belong to very old school. So I always prefer to open an Excel file, do my maths. So just the liquidity preference. So this is one of the way we actually use to understand the maths behind the investor's mind, the founder's mind. So it's always better calculate your numbers. Please do your homework before saying yes to any term sheet.
We have another one from Vikas. Can we measure the valuation of an idea? If possible, required the PPT template, basic mathematical formula to find out the valuation of any company.
Right. Okay. First, can we measure the valuation of any idea? Definitely, you can measure the valuation of an idea. There are different methods to value any company. You must have heard about DCF method, relative valuation method, venture capital method. But as per like my understanding, DCF never should not be applied to an idea, because DCF is always applicable to those companies where you can easily project your cash flows. But for an idea, how can you project your cash flow? Because you have still not run your demo. You have still not entered into the market. You still don't know what kind of traction you will get. So it's always advisable to go back and understand if similar kind of company has bring up something to the table, to the market, and what kind of the traction that they have achieved. I am not asking you to use their valuation, because we have seen in 2022-23 that the absurd valuation has been given to the startups, and the kind of valuation slashes has happened, which is actually bringing a lot of negative publicity to them, and a lot of wastage, like a lot of angel investors and VCs have lost up their money. So it is definitely possible to value your idea, but to that, you have to understand the first step to value your idea is identify the matrices which you will evaluate every single day to understand the performance of your business. For instance, like for an e-commerce company, if you have launched your app, so the active users, daily active users, weekly active users, try to understand them and then perform your relative valuation. So these kind of trials and errors would help you to understand the value of your idea. If possible, require the PPT template. I would rather suggest you instead of taking the PPT template, because see, we have created a lot of pitch decks for our companies. Every single company has altogether a different pitch deck, because you have altogether different matrices to evaluate a company. Problem statement could be different, solution could be different. So while creating a pitch deck, we actually have to sit down and do our homework. It actually takes us a lot of time to understand that, okay, we need to mention this in a particular pitch deck, should not mention this in a particular pitch deck. So there are a lot of do's and don'ts in a pitch deck. So it's always advisable to understand your matrices first and then to put down in your PPT, because a single template would not work for everyone. Basic mathematical formula. Okay, I've missed one. Okay.
So
I think the last question has gone.
Formula to find out the valuation of any company. That was the third question.
Okay, so that I mentioned that we have a lot of different methods to find out the valuation of the company. So one formula cannot be applicable to all the companies. So you must have heard about like Gordon growth model, dividend discount model. So dividend discount model would not be applicable to your company because that is applicable to companies who's paying out the dividends. DCF would not be applicable to you because DCF is for the companies where cash flows can be easily projected. So there's not one formula to understand the value of the company. So I'm sorry, so there's actually not a formula here. Okay, so many of the VCs are not replying to emails. So what to do and how to write an email to the VC. Okay, so a reality check, an ugly truth. VCs do not reply you back. Honestly, this is not how the world works here. You need to have some connections to reach to their VCs. So please try to understand that the VCs every single day they receive thousands of the pitch decks and they cannot reply to every single person. And for that, it's always advisable to attach a small video where you are highlighting your product, you're highlighting your services. Your pitch deck needs to be very crisp, very smart, like very stellar pitch deck. You need to be there. And an email to the VC, write something which actually adds up to the curiosity of the VCs to open your deck. Your email should not be like a two-pager. It can be two-liner, but those two-liners should be something with which a VC can relate. Okay, there's one thing that I wanted to mention to everyone is uh, we have multiple VCs available in India, outside India, and it is not possible that a VC is sector agnostic. It could be possible that one VC is catered or focused towards one sector. So first of all, identify to which VC are going to send your deck. So hypothetically, one VC is focused towards health tech, and you are sending you and you're an e-commerce company, D2C company, you're sending your deck to that VC. He will never going to reply you. So first of all, shortlist your investors list, shortlist your VC list, and then start sending the mails.
Okay.
I hope I was able to answer the questions.
Yeah, I think we do not have any more questions as of now. If you want to quickly take us through the Planify platform and talk about the platform itself, I think you can do that, Ishma.
Sure. Let me quickly do that. Let me know if you can see my screen. Right.
Yeah.
This is more or less the Planify's dashboard. And once you be like sign up to the website, you can see all these companies which has received the funding from us, or the companies who has actually listed on our platform just to get the attention of the investors. Because every single day we got millions of new investors coming onto our platform. So we actually list down all the companies here. So we have segregated all the companies between like startup funding companies, and then we have like early funding, which is actually started just receiving some kind of traction. And these are actually the funded companies who is not looking to fund anymore because they have raised whatever the funds they wanted to raise from by our platform. This section, this founder section is where we have segregated. So in case if you wanted to raise 0.25 CR to 5 CR, you just need to go there, put your details. Our IB team will come in contact with you. If you wanted to just launch your company on our portal only itself, so that the investors in PE funds and the VC funds and the investors will, you'll get some interest from them, you can do that. Then we have this Prarambh services. This is specifically has been formulated for the founders, where we have listed a lot of services like if you want to help us to create your pitch deck, we can do that. If you want to get a valuation report from us, we can do that. If you wanted to get like a DD report from us, we can definitely help you out in that. So we prepare scorecards for the founders. We prepare due diligences where we also cover the legal due diligences because we have in-house lawyers as well with us. We have a proper valuations team with us, so they can create your valuation models. We have pitch deck team here with us. They can help you out to create your pitch decks. So these kind of services are available for the founders with us. Then this is for the angel investors. If you wanted to have from the angel investors, just click there and you will get all the kind of companies that you wanted to invest into. Then we have the private boutique. We have a prime subscription where this is specifically for the investors. Planify has Planify is one of the platforms in India which shares the research report of the private companies. So you have must have heard about like Bloomberg, Capital IQ, Thomas Reuters, who create the reports for the publicly listed companies. But for a private companies, you have not even encountered with anyone. I think we are like one or two second of the platforms in India who actually prepares the research report for the private companies. Let me take you through one of the research report that we have created. Uh, so maybe which one would you like? I'll just show you maybe Zerodha. Uh, yes. So this is the kind of report that we create. We have shared the detailed analysis of Zerodha, and you can see that on our YouTube channel as well. So the kind of detailing that we provide in our research reports, the kind of number of shares, what actually is Zerodha, what kind of business model they follow, their revenue segmentation, and then how are they performing as compared to their competitors. So we discuss all these things, and then their revenue has jumped. So why the revenue has jumped, why the CAC has actually jumped. So these kind of analysis, then the peer analysis with other companies as well, their financials over a period of time if you wanted to see. So annual reports about their founders, whosoever has funded in these companies. So this is a bootstrap company, so you cannot find anything in the funding companies. But otherwise, we also mentioned about the different round of fundings that these companies has received so far. Planify is all about helping the founders to reach to the next level. Our check size varies from 2 CR to 25 CR. We are a sector agnostic platform. We are always looking for the hidden gems who are actually solving a real life problem, who have a sustainable business model. We are always in a search of good companies so that we can actually help them with our capital, with our expertise, with our sector knowledge to reach to the next level.
Okay, so thank you so much, Ishima. I think we have a couple of questions. People want to know how we are going to share the template link. So we have asked you to register yourselves. I hope you have received the joining link through the registration. So we have your mail IDs and we can mail you the template. We have another question. How can you help in fundraising and how much are you charging?
Okay. So as I mentioned, we are a sector agnostic platform, and our check size varies from 2 CR to 25 CR. And we also, just apart giving you the financial capital, we also help you to mentor you, to guide you, and to make you meet to the other CXOs in the in the industry, which will help you to reach to the new revenue base. And how much we are charging? We don't charge anything before fundraising. So there is like no platform fees. There is no any upfront fees, because we always believe that founder is already struggling with his business, with his idea, everything. We always prefer to first evaluate the pitch deck, and if your business matches with our investment thesis, we'll take it forward, and then we offer you a term sheet. So upfront fees and anything is not there with Planify.
Okay, so I think we had a good session from you, Ishima. Thank you so much. I think it was very informative. Uh, there was a lot to learn for everyone, I'm sure. And we'll be looking forward to have more such sessions with you. We can also have some physical sessions,
Sure.
like based on the interest we will receive from this webinar, right? We can generate some traction for Planify,
Sure.
the people who are interested to raise funds through you. Uh, yeah.
So
So,
guys, just to mention, I mean, in case of any questions, any doubts, please feel free to drop us a message. Ankit would have our email ID also. So in case of any doubts, I would be happy to help you. I would be happy to guide you till the time I have the knowledge. So please feel free to reach out to Ankit, and Ankit can get back to us with any of your
you can
questions.
write me those who are joining from the incubator. If you have any, if you want to connect to Ishima, I can send her a mail and
Yeah.
connect you
Yeah.
with
Please
her
feel
and her.
free. So there is Please don't feel that your email would not be reverted back or replied back. Please I make it sure that I'll take care of every email, every question.
Thank you so much, Ishima, for taking out time today, and looking forward to more such interactions
Sure.
and a healthy collaboration with Planify. Thank you so much for today's session.
Thank you. Thank you so much. Thank you everyone for joining the session. Thank you, Ankit, for having me. Thank you so much. Bye. Bye, everyone.